This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Coveil. Not filtered, raw, honest. That's my passion. My guest today is a former partner at Apollo, one of the world's largest alternative investment companies, founded by Leon Black, a quite famous name in the world of finance. If you're not familiar with his story, go check it out. It traces back to Mike Milken, another man that if you're not familiar with, you should check out. My guest today, Sachin Khajuria, uses his unique experience to share with us how private equity works. I mean, you hear this phrase 2 and 20, but do you really know what's going on? I always enjoy these conversations to get behind the scenes with somebody who has lived it and breathed it, and Sachin has. Without any further delay, let's jump right into my conversation and get behind the scenes and have that better understanding of that mysterious yet very profitable world of private equity. I hope you enjoy this conversation. Let's jump right into some basics. Going through your world, I had to kind of re-jog my memory, and you're going to correct me where I'm wrong. But I started going through your world and I was like, oh, wow, this was the kind of stuff before. And when I was thinking about Wall Street back in the day, early 90s, I was reading Barbarians at the Gate, The Predator's Ball, Merchants of Debt, a lot of the big names that I think are still part of the world in many ways. But here's my opening salvo question. Was private equity, the phrase, a rebrand from leveraged buyout to some degree?
Private equity encompasses more than just leveraged buyouts. You have control investments in operating businesses or early stage businesses that are designed to scale up. You have significant influence investments, so minority investments, but where you're possibly the largest or most important shareholder, particularly in today's market with the volatility we're seeing in 22, what we've just been through with the pandemic. You have a growing class of private equity investments, which you could call hybrid capital or tactical opportunities, which are structured equity. You have a little bit of downside protection, but you're giving up a bit of upside. Private equity is definitely broader than just leveraged buyouts.
Would that be the way that it started? If I'm thinking back to the way the branding had unfolded, of course, 80s, early 90s, leveraged buyout was the term. I don't think the term private equity was as popular, but at some point in time, there was a shift.
Yeah, so it started with guys like Kohlberg, Jerome Kohlberg, then later KKR, bootstraps investments. You'd pull some capital together, you buy a company out. I think they were called bootstraps investments. Then they went into buyouts or leverage buyouts through the 80s and 90s. And you start to hear the term private equity a lot more as the first of the major firms started to go public. At the core of private equity, you do have leverage buyouts. Absolutely. But I think private equity is much more than just leverage buyouts. If you look at all the structures today, you have closed-end funds, those traditional 10-year funds that raise a bunch of money through commitments, and then those commitments are drawn down over time. You now have perpetual capital vehicles, vehicles that are always holding capital or paying out distributions. You have so much more than just the one fund structure, LPGP, doing buyouts today. Kind of in private equity 2.0 or even 3.0, frankly. That's the way I look at it.
Fair enough. Here's where I really want to start with, because I think this will bring people's attention in. It will also get my attention in. When I look at the title of your book and I look at the subtitle, there's a word in there, masters. As we start this conversation, I want to know who the masters are, so to speak.
You would have Blackstone, Carlyle, KKR, Silver Lake. I mean, there's lots of very, very good firms. I've looked at some of them. I'm an investor in some of them. When I talk about the masters of private equity, I'm talking about the best people in the industry that I've seen, the best firms in the industry that I've either worked for or with. the firms that I'm giving money to.
But I want to take you back to the beginning because you've been around, so you know what the landscape is. I want to establish the landscape. This is why I'm bringing up some of the names and my recollection of history and talking about it, leveraged buyouts. I want to kind of understand what was the foundation. If I have to go back in time, somebody like Mike Milken was an integral figure in the foundation, correct?
You would have a lot of individuals who were involved in either financing buyouts, but not necessarily executing them as investors on the equity side. Those are firms like Drexel, and there are plenty of others, by the way, that were more on the financing of buyouts. Lots of investment banks were doing that. And then you would really have, I think what's more relevant to your question is the private equity.
The KKRs of the world.
KKR. I mean, when you think of the original private equity firm, it doesn't take too long for KKR to cross your mind. And I think that's fair.
Are they ground zero to some degree? I remember the book Merchants of Debt.
I'm not sure they're ground zero. I mean, you have firms that you don't talk about much today, which were around at the beginning, even way before I entered the industry. Forsman Little was a fantastic firm back in the day.
Teddy Forsman.
Exactly. That's one example. You'd have other firms in Europe as well that you don't hear about much today, but were pretty instrumental in the development of the industry. When you look at firms like Forsman Little, and you look at firms like KKR, some survive to this day and thrived, and some probably exist in some form or fashion, but not in the way that they used to. When I was kind of growing up, I was at college in the early 90s. Those were the sorts of firms that people would talk about, which was, oh, wow, do you want to go into that sector at some point, working at a firm like that or a firm like that?
If I take it back, okay, I bring up Milken. He's on the financing side. Guys like Forsman, KKR, they are finding the opportunities. Looking back in time, and also, I guess, looking at most recently, an example like the Toys R Us example, people love to come out and lament and say a leveraged buyout or private equity, they caused this company, all these jobs got lost, this and that. But I think there's another way to look at this that people often don't look at, which is some of these companies get fat and happy and are not really doing much. They leave themselves vulnerable to otherwise smarter people saying, hold on, there's a better use of this company. There's profits to be unlocked here that the current management, they've just been around. They're not really doing much anymore. The current management's just sitting on their hands, so to speak. Why don't you speak to this issue, though, this kind of debate? On one side, people just say, oh, some jobs are lost. Okay, that's capitalism. Jobs get lost all the time. I don't really care if someone says that. But then there's the private equity people that are looking around at these various opportunities and seeing things that other people don't see.
You're raising an excellent point. And I think it goes to one of the key reasons I've written the book, which is that we need to move away from thinking about private equity as if it's either good or bad, that it's black or white. Is it perfect or is it terrible? When you look at some of the press private equity's got over the decades, even today, when you look at some of the debate about whether it really works or it's just financial engineering and so on, some of that is cast in a is it good versus bad way. And I'm not sure that's realistic. I think that ship has sailed. I think private markets, including private equity, but also things like private credit, real estate, infrastructure, so on, they do deliver cash on cash returns to investors. We're talking about pension funds, retirement systems, sovereign wealth funds, high net worths, and increasingly actually retail investors. They do deliver cash on cash returns. It's not paper wealth. Those returns are generated because they are creating value in those companies. Now, of course, it's not perfect. Of course, sometimes it goes wrong. But isn't that true of every single industry? I think what you're getting at is that sometimes, even if private equity is acting as a catalyst in some way to try and get to where that company is going to end up, where that business is going to end up, sometimes the outcome isn't as expected. But in all the deals I've been involved with, pretty much without exception, the companies have been left in a better condition at the end of the investment than at the beginning. They're usually bigger. They've usually grown. That usually means they've hired more people net. May not be the same people, but net, they've hired more people. They've got a bigger workforce. They're doing better. That's why you can sell them. The next firm or stock market or whichever structure is used or transaction pathway is used to buy the asset at the end, they're going to want to hear a positive story too. They're not going to say, well, you've done this thing so the company hasn't generated any value, but I'm still going to pay you for it. There's got to be sort of a positive equity story at the end. And I think when you think of it that way, when you realize that, look, this is an industry that is growing. It's an industry, by the way, where America leads. It's an integral industry in funding tomorrow's retirees. Then you start to say, okay, of course it doesn't always go right, but let's also talk about all the times that it does go right. And let's also recognize through the immense shocks we've had, the financial crisis, banks went bust, insurance companies went bust. I can't think of too many private equity firms that went bust.
Hold on, if you got that 2% coming in, it's hard to go bust, right?
Well, not exactly, because you're only going to be as good as your results. Investors are only going to keep coming back to you if you're delivering. If you're not generating returns and you are charging more than a passive investment fund, you go to a BlackRock or a Vanguard or one of these other fantastic firms that does a lot of great investing, often passive investing, index tracking, ETFs, things like that.
Let me stop you saying, I don't really think that you think index investing. It's great if you're running a massive mutual fund that's just tracking the index, but that's not a super skill investing strategy. I don't think you're saying that.
Well, no, I think what you have to look at is you probably need a little bit of everything. Before, people used to say, 60-40 stocks to bonds or something like that. Let's have some split between the public markets. And I think going forward, as individuals, we're going to start to say, well, hang on a minute. Do I have some capital that I can tie up, semi-liquid? Should I put some alternatives in the mix? Should I have maybe 20% of my balance sheet in what I call mainstream active investing, but it used to be called alternatives? I mean, alternatives just means not stocks and bonds. Probably at least 20% if I can afford to tie up a bit of capital because it's liquid. All those firms that are doing the more liquid stuff, because it's passive, as long as they're replicating those industries correctly and they're buying and selling it broadly at the right times, you're generally going to do well over the very, very long term, generally. But you may also, to fund your objectives, which could be retirement, could be financing a major purchase or whatever, it could be a combination of all, you'll probably need a little bit more return in the mix. But of course, it's a liquid with private equity and other forms of private capital. Because it's less liquid or illiquid, you are not going to put all of your money into it. It's not about one is more skillful versus the other. You probably won't do going forward all of one or all of the other. It's more about being realistic that in the same way that we accept stock and bond investing, we should just accept that this kind of mainstream active investing, this alternative investing, is pretty normal. And then it's about finding the right funds and firms that we believe in, that have the data that we trust, the results, basically, the values we believe in. And where the book comes in is how to help you identify what I think is a winning mindset and psychology of some of the best people I've worked for. It really is about having a mix. And that's why I want to move away from this idea of stocks and bonds are normal. Now let's question whether private equity is good or bad. Let's move on.
I'm at like 7 books on managed futures. I'm right there with you on the alternative headspace. I think it's interesting that there are players around the world that have developed strategies outside of a, hey, we track the index, or hey, we're buy and hold. So I find it terribly interesting if an individual or a firm has developed a strategy that perhaps has a different correlation on that return stream. That's really interesting. It's not talked about enough because most people have just been seduced by have a mutual fund and just buy and hold and forget it and nothing else. I'm an alternatives homer, so I have to admit my bias.
Well, I mean, look at this year. It probably would have been pretty scary to look at your IRA or your 401k this year if you're entirely in the liquid markets. You might have entered the year feeling wealthier than you do now. The question is, can you afford to tie up a bit of your capital, knowing that hopefully you don't have to sell when markets are low anyway, and put some of that capital into these active management strategies? And if you can do some of that, then you've got to realize it's a people business. There's nothing automated about it. There's no artificial intelligence or machine learning or trading. There's nothing that can just replicate what private equity folks do. Because it's a people business, it relies on the decisions made by these investment professionals and the management teams they partner with, absolutely key. And they act like engaged owners, not passive investors. And that's a core theme in the book. These guys eat what they cook, and they think and act and organize like principals, not just advisors. That's not something that an ETF fund is going to get you, because these folks are dealing with operating businesses, trying to improve them before they sell them on.
Let me read a sentence to you. And I think this is from Marketing Language with your book. I'm not sure, but I'm almost positive it is. But it says, and I'm just quoting here, it doesn't cause me any concern, but I'm sure some people might read it and they're going to think something. It says 2 and 20 is an unflinching examination of the mindset that drives the world's most aggressive financial animals to consistently deliver market-beating returns. And I guess the phrase that caught me, which is aggressive financial animals, I like that language. In the modern world, I might even say the modern woke world sometimes, where language gets dissected and ripped apart, people might not be used to that language. I like it. What do you think about that phrase, aggressive financial animals?
My personal choice of words would be more like successful financial investors.
That's kind of boring, right?
Now you know why I don't work in marketing, right? So
I think it's a fair, let's be frank. Okay, you were at Apollo for a long time, right?
Yeah. I was there for just over 7 years, and I've been an investor for a long time.
Apollo was started by Leon Black, right?
Yes, and 2 of his co-founders.
Right. Leon goes back to a connection with Mike Milken. So there is, anybody that knows some of the names, aggressive is a word where people are going to be like, well, okay, you can't just say these guys are buy and hold mutual fund guys. These are aggressive guys that are trying to figure out ways to find inefficiencies and make profit. They don't apologize for that. Some people listening might say, well, but there's some controversies, Mike. Look, there's controversies everywhere. But on the whole, I think people would have to step back and look at the last few decades, last 3 decades, at least 4 decades, and say that there has been a financial engineering here that has helped to bring us to where we are today, for good or bad.
It's a fascinating slant. I think it's wrong, because I'll tell you that even when I joined the industry, working in a new sector, infrastructure that's created out of nothing pretty much, or when I went into buyouts or distressed investing, the way people invest, their formula for success was never driven around a single individual or even a small group of individuals. And that includes tenacity or any of the other things that you're talking about. No, it's not about one person or group of people. It's not even actually about any one particular firm. What I think it's about is a common series of traits and principles. They may get expressed differently, individual to individual, but it's not just aggression. I mean, you can be tenacious and get nowhere. And in fact, I think some of the smartest people in the industry today are actually quite shy.
If somebody's aggressive and they're taking insane risks, so they're going to quickly be out of the game. So I wasn't using the word aggressive in a negative connotation. I could see how some people would.
I see where you're going. People who are like smoking out, sort of trying to hunt for that profit and all of that sort of stuff. But it's just so much more than that. I think it really starts with very, very clever ideas. Let's look at a few sectors that I was very lucky to watch or be part of. Satellites came out of nowhere. Private equity started investing in the satellite sector. And in the beginning, it was, well, you can't see them. You can't exactly fly up and fix them too easily. Where does that sector come from? Insurance. Not many people were doing that before the financial crisis. Now, a lot of people are doing it. Pharma. Some folks were doing it. But look at life sciences franchises today. It often starts with ideas. And those ideas can be brought to the firms by very smart managers. They can be self-generated theses. In fact, some of the ones I've just mentioned were actually entirely originated at private equity firms, I think, or at least largely originated at private equity firms in other cases. Then they spend a lot of time, a lot of effort, analyzing a lot of data, meeting a lot of people, building a lot of relationships, figuring out whether those theses are true. For that, you need a lot more than just tenacity. You need curiosity. You need to be like a financial investigator. You need to have a natural acumen for wanting to figure out how things work. I think when you look at, for example, in the book, we talk about all of these things like the attraction to complexity. We talk about the ability of these firms to evolve. So they've got these smart people. Of course, I'm talking about the leading firms, the ones that are doing well, the ones that are outperforming, the ones who outperform the public markets as well. They continue to evolve. They'll move from one sector to another. They will create new fund structures. Look at what they're in today. Social impact investing, sports investing, sports teams, lots of things, renewable, we probably didn't think about back in the day.
Let me get some specifics here. I'm really curious if there was an overall number. So let's say you can imagine, you don't have to rattle off all the names, but if you can imagine in your mind, let's say the top 10 private equity firms, and for the typical after fees return that they might offer year after year, decade after decade to the likes of the public pension funds, the firemen, the teachers, et cetera. What's a number that I can wrap my head around? What is a typical number and how consistent could that be? Give me an idea. Give me a feel for if I'm thinking of that top 10 group of private equity companies and the types of returns they deliver. What am I looking at? What can I understand?
So I think we need to look at it in different buckets of risk-return trade-off. So if you look at buyouts, when I joined the industry, we were taught on Wall Street, Morgan Stanley, analyst program, associate program, etc., in investment banking and mergers and acquisitions and leverage finance, that private equity firms, when they're doing leverage buyouts, are typically looking for IRRs, internal rates of returns, in the 20s. Could be low 20s, depending on the business plan, the safety of the business, the risk-return trade-off. Could be much more. There's more risk involved on a calculated basis, of course, hopefully on a disciplined basis, then that deal may be expected to make a better return. So I think you want to be in the 20s in IRRs.
Before fees?
So here's where it gets interesting. Then you have different firms that have different kinds of deals they're good at, comfortable with, and like the profile of. So some firms would rather pay a little bit more for what they see as a safer bet. Doesn't always work out that way, but that's kind of the way it's seen. And then they could be fine to get returns in the late teens net of fees. Because they're like, look, the band of outcomes here is narrower. You're less likely to lose your money. So your downside is less. But therefore, you're not also looking for 30, 40, 50% returns because, hey, you've traded something for something else. You've traded some upside for some downside. Some firms are better at that. Other firms are happy to take more risk by, let's say, going in for businesses that may be excellent franchises, but they may be in more trouble at the time, or there must be some other reason why they're able to procure them at a lower value or generate that investment at a lower value. Of course, they're paying less. That probably means they're putting less debt on it. And that probably also means that because they're paying less and they're putting less debt on it, it actually doesn't necessarily mean it's riskier just because the business is in trouble. It also just could be structured appropriately for that level of risk. But just given the situation, they may be looking for a slightly higher return. I think you've got to sort of start actually with the gross figures and say that private equity is generally targeting in the 20s. Let's talk about journalism as a general term. There's no but when I think of, okay, where do I want to allocate my capital? I'm looking at firms that are consistently over time making in the 20s at least. They should be making in the 20s. And if they have the odd fund that dips below, there may be a very good reason for that. In general, everybody was not doing that well, so still they're outperforming. So you want to look at the absolute return. You also want to look at the relative return, because there are some firms that can make 300, 400, 500 basis points above the other folks in the industry, their rivals, consistently over years. I think you need to look at both of those kinds of metrics. And then when you go into other risk return buckets, like you talked a little bit about hybrid capital and structured equity and all of that, that's still private equity, but it's just a different product. I think there again, you're going to have this range. I definitely look at the gross returns that are coming out at the shop floor, so to speak. And then I look at the net, and then I look at how much better they're doing relative to the public markets and to their rivals. Those are some of the key things I look at.
I got to stay at the title of your book for a second. It's such an interesting phrase. Some people will know what it means. Some people won't. I'm going to let you explain it just because we should put it on the record as to what 2 and 20 means. But I'm curious also, when it comes to the 2 and 20, has that become the de facto standard for, let's again say, the top 10 private equity firms? Or are there some of those private equity firms that are doing a different fee structure? I can think of in the hedge fund space, a guy like Jim Simons or formerly Steve Cohen, they were charging probably 50% of the profit side of it. I don't know what they were doing on the management fee. Why don't you go ahead and explain 2 and 20, and then go ahead also and explain if there are any divergences in terms of that fee structure these days.
2 and 20 is recognized as a sort of industry benchmark for compensation in private capital and private markets, whether it is private equity or hedge funds. It's common in both. And the standard fee arrangement, I'm not just talking about the largest firms here. I am talking about across the industry. Standard fee arrangement has been to charge both a management fee, keeps the lights on, pays the salaries and so on, and a performance fee. The management fee is typically this annual fee of 2% assets under management. And of course, there's going to be variations. There's going to be some firms that are starting up, it's an incentive, they're charging a lower management fee, 1%, could be less. And some that charge a bit more than 2. In general, 2 is a reasonable benchmark. Certainly a lot of the funds that I get offered are in the 2 and 20, the 2 is reasonably standard. The performance fee, the second fee, or the incentive fee, is actually really where you get this alignment of interest between the investors and the investment professionals. Because that is often, typically, around 20% of the profits made from investments. So if you don't make any profit, there's no 20%. And it's often above a benchmark. So you have a minimum hurdle, let's say, of 8. As long as you meet that minimum hurdle of making 8% IRR, then sure, you can charge 20 on everything or 20 on some other slice of that performance. Well, 2, which is the management fee, and you have 20, which is the incentive fee. It is absolutely the case that there is quite a good deal of variation at all levels of the private equity industry in that fee structure. It tends to be more down than up. Why? Because the industry's funds are generally getting bigger. If you start with very, very big funds, then it may not be 2 and 20, it may be 1.5 and 17.5, or it could be 2 and 20. There are examples of both. For most firms, because remember, there are thousands of private equity firms, not just the top 10. There are thousands, and there are probably hundreds of very large ones. That is the typical arrangement.
There's also, I'm sure, a Pareto principle going on here. The biggest are probably controlling the vast majority of the assets, correct?
The largest firms obviously couldn't scale. Sometimes the scale can slide a bit. I'm going to get into talking about any specific terms at any specific firms. That wouldn't be right. But when you look at the larger funds, then you may get more variation in that fee structure just because funds are so large. You have, let's say, private capital is around the $12 trillion industry, roughly speaking. Private equity of that might be around 7 or so. The major firms, the very big firms, might have 2.5 trillion of that 7. So the tip of the spear.
When you say major firms, you mean top 10, for example, or?
Yeah, around the top 10.
The top 10 might control half of the assets, something like that.
Well, no, 2.5 out of 7. It's a big tip of the spear, but there's a big spear. It's very important to understand that. It is a huge industry. There's a lot of firms working. And a lot of firms that people don't often think about or hear about, often because you hear more about the ones which have publicly listed stock now than the ones which are still private. These are sort of rough order of magnitude numbers at the moment.
The structure, the 2 and 20 structure, I've always thought, because I've seen the same thing in the world that I write about when it comes to managed futures or trend following. I mean, for example, the guy that owns the Boston Red Sox currently, as a trader back in the day, his fee structure was generally 6 and 25. Well, that's the way you end up buying the Boston Red Sox at some stage of the game. Hey, I say more power to him. If the customers and the clients are happy with the returns and there's no jealousy here. Now, there is going to be some jealousy with some people for sure, because ultimately, if some of the private equity guys make billions of dollars for themselves, even if they're delivering these great returns for everybody else, some people are not going to be happy with that. Let me ask about the management fee, though, part. I'm curious, Are there some actors in the private equity industry who have realized, and I've actually had this said to me by VCs in the venture capital space, that some venture capitalists will actually look at it and say, hey, let me get that big AUM because the 2% management fee is great, frankly, regardless of what we do. Is that an issue for some firms that they realize, man, even if we don't have the skill of a KKR, if we don't have the skill of an Apollo, if we raise XYZ amount of dollars and the industry trusts this 2 and 20, we can go several years making a lot of money and maybe not have the skill to deliver returns?
You could possibly go a very, very short time frame, more like a few minutes rather than several years. The investors are pretty smart. And as soon as you don't start to deliver, you're going to have a tough time. So no, I don't think that really happens. I think what you can find is that, of course, in the balance between looking at how much money they can raise and how much money they should raise, of course it's possible, because people are not perfect, that sometimes firms may raise more capital than they can invest at the sort of returns that they used to make when they had smaller funds. I haven't seen that in any of the places I've worked, frankly. I actually don't have any friends who work at firms where that's happened, but I've heard about it. I don't think it's as big of a phenomenon as people say. It's tempting, and you see it in some of the media, and you see it. We talked about this characterization of, is private equity a good thing or a bad thing? You sometimes see that. I don't think it's really rooted in reality. This industry is all about long-term performance. The reason that these investors go to these firms is because they're able to deliver a very strong return, alpha, per unit of risk that they cannot get somewhere else. That's not the 2, that's the 20.
You've mentioned several times about the people side of this. Given your background, former partner at Apollo, one of the most successful shops around in the past and ongoing, can you speak to, from the top people at Apollo down, what did you take away? What was the mindset that you were seeing behind the curtain at such a successful firm, that where the average college graduate that wants to become an entrepreneur or work for an investment bank, they're just hearing what their college professor told them. But here you get to be behind the scenes. You get to be behind the curtain, one of the most successful firms ever when it comes to this style of thinking and investing. What were some of these mindset issues that would separate what you were seeing at Apollo versus just the man on the street that doesn't understand how a game at this level is played? What were some of those philosophical mindset issues that you would have walked away from that changed you forever?
I think it's very important to realize, I don't think it's specific to one firm. Of course, places I've worked, like Apollo, have it. But also the places where I invest today have it too. Blackstone, Carlyle, other firms too. There's some funds even run by asset management arms of banks like Goldman Sachs. They have some great funds that have a similar mindset, or rather they have people who have a similar mindset. I think what you're getting at is, we talked about this a little bit before. I think there's a fundamental tenet, which is that these folks are acting, thinking, organizing as principals, as if they are the owners of the business. That is really key. They're not acting like consultants or bankers. That's not a bad thing, by the way, on the part of consultants or bankers, but they're advising. When the deal's closed, they will still advise. They're not in it for the 5-10 year life of the deal, if you see what I mean. By devoting a significant portion of their lives to these deals, remember that it could take 5 years, 10 years to enter, then ultimately exit a deal. That's an important part of an investment professional's life, not just their career. They are proactive in assuming individual responsibility as well as collective responsibility for the deal. They really own it. That's what I've seen. They really care. They absolutely care.
They're not just consultants getting a fee, it's their money.
I don't want to say anything negative about consultants, because it's just a different job. They've got some of their own money in. They have a lot of other people's money in, these pension funds and so on, but they care about all of it. And part of the reason they care about all of it is because they have an incentive to care, but it's also who they are. They're more principal kind of people than advisor kind of people. And that's one of the things that, when I was in investment banking, I did 5 years of investment banking. A lot of my friends left after 2-3 years and they went to firms like Carlyle or other firms to work, or KKR or whatever. Some of my best friends left after a year or two, and they did what I ended up doing after 5. I wanted to spend more time learning. Everyone has a different path. They wanted to get into it earlier. But we all decided at some stage, are you the sort of person who wants to take the decision as part of a team, as part of a group, of course, or do you want to have a portfolio of different deals, consult, be an advisor, and then move on to the next? And I think it's really who they are. When something doesn't go right, it's like hand-to-hand combat. They have to get it right. They want to get it right.
Hand-to-hand combat sounds aggressive.
It's a phrase. They want to get it right. You don't lose your home. They don't want to lose the investments. They really, really care. They really care.
Speak to this word principled, though. I want you to kind of break that apart because you said that several times, they're principled. What does that mean exactly to you?
Principle is in with an AL at the end. So like an owner, director, decision maker, owner, entrepreneur, that kind of principle. AL at the end. And so there's actually a subtle difference because compared to the raw emotion of ownership that an entrepreneur or family enterprise may have, it's our business. We may have sacred cows. We don't do this. We don't do that. In private equity, what I've seen, private equity works very well. They have the combination of this impassioned sense of ownership with the ability to detach when it comes to analyzing problems. So they really care, but they can also be dispassionate. And I think these are the sorts of things that are at the absolute core of what I've seen. That's why that when I've seen these discussions, the truth is they just want to get to the right answer. They keep asking the questions, keep analyzing the data, keep building the relationships, keep talking to experts, keep working with management, keep doing their work. They just want to get to the right answer. What is the right answer? What is the right outcome? Because only if we're honest about what the right outcome is going to be, are we going to win many, many more times than we lose. When we win, everybody does well.
Let me give an example here, something that I brought up earlier, just as a topical headline type thing. And I mentioned the idea of Toys R Us, and there was some criticisms in the paper of private equity. Oh, the people lost their jobs and stuff like that. At my age now, I can remember going to Toys R Us a whole bunch as a kid, starting to buy presents for kids and stuff like that as I got older. Now, comparing a Toys R Us experience to an Apple Store experience or something, literally, Toys R Us was like a warehouse with stuff put on shelves, and it didn't change for decades and decades. There was no brain power at all put into the experience or anything. And this was a place selling toys. It was like a warehouse of stuff on shelves. It was clearly the bare minimum. So I find it interesting. One side, the big newspaper headline might be, Toys R Us employees were laid off or something like that. But then you think, how was that business operating for so long? What was going wrong? What was going right? We never get into those finer details. We look for these headlines to make people feel a certain way, perhaps feel bad. But then the reality is when you get behind the scenes often, this is capitalism. Capitalism is about reinvention, finding weakness, improving things. And this is the best system we got at the moment, isn't it?
Let's fast forward to where we are today. Today, there's the bricks and mortar business you're talking about. So you have online competition, whether it's Amazon or wherever. That's going to eat up businesses that don't need to exist or transform them or catalyze them into transforming in some way. And what you have today is that a lot of these firms, including KKR, which you mentioned, actually look at ways of giving some of the share of the equity back, giving some of the profits out. And it's become a really important phenomenon where rather than the dynamic you're talking about, which goes back to some of the good versus bad press, I think the position of these firms today is they're like modern industrialists. They're starting to play that role in the economy. And part of that is giving back. I mean, I think one of the best things that some of the major firms have done in recent years is make enormous progress to counter that narrative that you talked about. That means investing directly in communities, literally investing in the local area where they're working, whether it's businesses they're investing or their offices. It means, okay, we made so much money on this particular deal. How do we give some of that back as a one-time check or some other compensation mechanism? Or How else do we give back to all the folks, not just the CEOs, top people, but everybody who's worked on that deal? I think that's where the conversation is now, and that's where we should focus our time. Of course, in the past, and maybe even today, there are going to be deals that don't work out and you can pick apart. I think what's much more relevant when we think about the fact that private equity today is mainstream, it's coming to your door, if it's not there already. Your pension fund might already be in it, or they may be looking at it. You, as an individual, sooner or later may have the opportunity through some channel, could be a feeder fund, could be you as a retail individual in the future to invest in it. You have to look at where the industry is today. Because I must say, comparing the industry today to often the perception of the industry, whether it's the 90s or go back to some of the things you talked about, 80s or before, it's a bit like comparing the latest Apple iPhone to one of those Motorola brick cell phones. It's not even close. It's not even close. We are light years ahead of that today. We're now at a point where some of these firms are managing more than $100 billion. Some more than $300, $400, $500 billion. Blackstone, I think, is in excess of $900 billion. Those are funds under management. If you were to add leverage on some of the funds within that, obviously you have even more purchasing power off the dry powder. They're really these large mainstream investment groups. And particularly when they're public, a lot of them is about all of the themes that most people care about when they're looking at the kinds of values and behaviors they're looking for in investments. They're looking at firms that care about veterans hiring, about investing in the community. They are looking at firms that care about giving back to good causes or actually supporting in the pandemic. These firms are doing that today. And that's why we need to look at them as pretty normal.
I don't think you necessarily need to defend that. I mean, everyone's doing some form of, people might not like this word, but you're not using this word, but I'm kind of thinking about charity in a way. But I mean, that's not what you're saying. A lot of people give back. I don't think you need to defend that. I mean, because ultimately it's going to be, do the clients like what's being delivered? Are they willing to pay the fees? Do the private equity firms deliver? And this is the ecosystem. And if it works and the people involved like it.
Look, obviously that's the most important. Because of course, if you're doing lots of these wonderful things and you don't get any results, I mean, it's going to be a tough thing to recommit. But I do think investors look for much, much more these days, just like they look at the social profile of what they're investing in. Are they going into tobacco? Are they going into other things that they don't want to go into?
There's a whole other conversation. You and I could probably talk for 5 hours. I have one last question for you, though, and I'm curious this because I'm thinking about it from my perspective, too. If I think back to a time period like October 87, or I think about post the dot-com crash, the NASDAQ going down 77%, fall of '02. If I think about October of '08 and the NASDAQ lows, March of '09, if I think about what happened in March of 2020, or I think about the first 4 months of 2022, these are pretty event volatile periods. I know it's tough question because I'm asking for all these different players of different strategies to be grouped into one. But overall, how has private equity performed during these moments where the typical index fund gets taken to the cleaners, so to speak?
So I think it's important to be fair to index funds or passive strategies because you have to look over an appropriate time period. You could splice.
I just went back to 87.
I think the truth is the best firms are generally outperforming the public markets net of the fees paid, as well as providing diversification. I couldn't tell you whether that's every year since 1987.
Let me keep you at the event part. When you have these moments where people that have put their life savings in the index fund and the index fund takes a big hit, and we've seen this happen a couple times in the last 22 years, how has private equity performed relative to that? I'm curious. I don't know.
It's such a good question, and it's almost a shame we're ending on this because I think we could talk about it for a very long time. My experience is that in periods of dislocation, they do really well. Really well.
Why?
I think it's because, A, they have the ability to alter the timeline. I mean, remember, you're less liquid or largely illiquid. If it's not a great time to sell, you could just carry on doing your work for a little bit longer. You can make that acquisition. You could develop that organic growth initiative, or you could make that business transformation. You could change the time frame of the investment to some extent by a few years. If you get caught when you think everything's right to sell and things change and then, well, actually, we're going to change tack, or if you encounter issues. So I think it's a more flexible form of investing in that way. Of course, in liquid markets, you don't have to sell, but you're probably watching the valuation even more closely when it jumps up and down violently during big periods of dislocation. You're going to get changes in private equity valuations, but they tend to be valued quarter to quarter as opposed to mark to market every minute, like public assets, publicly traded assets. One of the reasons that they can do really well is that they can adjust their transaction pathway depending on the market conditions. That's one of the luxuries they have. I think the other reason is because they're actively managed. Because they're actively managed, people can take decisions. They can pivot. They can react. And maybe they don't always get it right because they're not perfect. But they can react to the circumstances. Whereas if you've got 20, 30, 40, 50 stocks in your portfolio and the markets are having a tough few months, to a certain extent, you just have to go with it or decide you take matters into your own hands and buy more if you want to buy the dip, or sell if you feel you want to get out. So I think the fact that they're actively managed through these periods of dislocation is another big reason. And it goes to one of the things that we have in the book, which is that I think that one of the tenets, one of the principles and traits I've found, which I look for in private equity firms when I'm putting money into these funds, is the attraction to complexity, good complexity. Complexity that is hidden to most, but is resolvable. How chaos can be an opportunity in disguise. The ability that these folks have.
Do you have a quick example you want to throw out for that?
I think the financial crisis. Investing in insurance businesses that are not directly correlated to the macroeconomy, but are correlated to the supply and demand of capital going into insurance. The recession that followed the financial crisis, a lot of businesses struggled. Governments weren't there to help. Some of these businesses would have fallen on their backs, and private equity was there to lend to them or build them up. Look at COVID. In COVID, look at all these sectors that were essentially like forced shut down. Travel, airlines, car leasing, hospitality, hotels, restaurants, education, schools, colleges suddenly had to go digital. I mean, these are all things that we all lived through. These are the sorts of sectors where private equity was looking and going, okay, is there an opportunity here? Maybe we're not necessarily buying these companies, but do they need capital? And there's no one else to help. And we can make a good deal for our investors and help these companies get back on their feet. That's happened in lots and lots of cases. Maybe we end on something that's in the press a lot. I mean, look at the pullback in big tech today, valuations in 22. And what are we looking at? We're looking at potentially a leveraged buyout of Twitter by a tech industrialist, by a visionary, by Elon Musk. Private equity firms might be part of that financing. Private equity firms may be behind a big tech leverage buyout led by an individual. Who would have predicted that? Who else could do that?
You really bring up an interesting point, too, because for the last, let's say, 10 years, especially if we look at something like social media, everybody has their complaints about social media. Look, I do, too. When you look at some of these firms, you start to say, well, are they truly operating to maximize their business, truly operating the way that if they've got the principal backers behind them would operate, or are they operating on some kind of personal ideology? I think that's what's really interesting about the Twitter situation is I can't imagine that Musk would do that direction. I can't imagine if private equity is behind helping him to pull something off like that. Everyone's doing that because they feel like there's something to be unlocked there that the current management can't unlock. And that mindset goes back to reading those books about KKR and how they could pull off an LBO, which is because they realized that the current management was kind of going sideways and there was an opportunity there.
I think I really need to pull you to this reality today that we are much, much broader than buy a company, change the management, do something they can't do. Much more often than not today, I've seen situations where they are partnering with a largely intact management team, trying to react to opportunities. It could be a dislocation caused by technology. It could be an acquisition opportunity. It could be capital needed for organic growth. I think today that's much more the norm.
That's still having to push the management team in a direction they might not otherwise have gone.
Well, no, it's more likely to be provide capital to fund a direction and collaborate. Because remember, management has equity too. They're aligned.
Sure. But that capital provided, as you've made clear in this conversation, is not just, hey, here's a loan. It's like we're coming on board to help with some of the decision making too.
Yeah, sure. At the board level, I think the best private equity folks don't confuse themselves as CEOs. They know what they're good at, which is being very useful. They don't just show up to board meetings. They do a lot of work in between board meetings. They have a lot of working groups. They're all over it. I think the collaboration is much more normal today. Of course, you can have personal changes. I mean, that happens all the time. But I think it's much more about collaboration today than the idea of, let's buy this because the folks who are running it aren't doing a good job. I don't think that's the majority of deals.
I brought it up because I think that is Musk's motivations.
That could be. I don't know. I guess he's probably on next week, so we can ask him.
When it comes to the public pension funds, what percentage of the private equity assets are they? If we took that $7 trillion, where is that $7 trillion coming from? Who are the clients, so to speak?
Depends firm by firm, of course. In some firms, pension funds are a third of the assets. In some firms, they're half the assets. In some firms, they're most of the assets. When you look at most of these firms, you'll find that pension funds and retirement systems make a significant portion of the assets. The other institutional investors, you'll have millions of pensioners, right, in the US and millions more globally.
But public pension funds generally, right?
Got a mix of both. I think it's important not to say it's all public. You basically have large institutional investors, public and non-public systems, major endowments, colleges, and so on. Sovereign wealth funds, I mean, they're huge. In a lot of foreign countries, the sovereign wealth funds, one of their goals, their missions, is actually to provide for citizens because they may have a different political system than we do in the States and in many countries in Europe. So I think the majority of the money is institutional investors in that way. That's the way it's been historically. But what is interesting is that when you look at the more individual side, it was just high net worths. And what we're moving towards now is, as we said, mass affluent. And then eventually, I think, as acceptance increases, you'll see more and more retail investors coming through. Today, you might find that 10 or 20% numbers of these order of magnitude, or very firm by firm, it might be retail assets under management, 2 out of 10 or so on. That sort of 1/5 might be at the bigger scale, and the smaller end, it might be more like a 10th or something. It's still the minority. And it's going to increase over time. We'll have more and more retail that's coming into the mix. It's probably even more incumbent, the smaller the investor, to learn about private equity now, to learn about the motivations, what the psychology of success is, before you actually have to take a decision. Because ultimately, you're going to have to answer a question when you want to put some of your capital into private markets, which is, am I being adequately compensated for the risks that are being taken on my behalf by these active managers? Am I being adequately compensated for those risks? And the corollary to that is, what do I really know about private equity? You need to be able to answer those questions. And that's really one of the purposes of the book, which is read about one person's views on what some of the winning mindsets are, what the winning psychology is in the firms that I've seen over the last 25 years.
Sachin, very cool stuff. The book, 2 and 20, How the Masters of Private Equity Always Win. The book is at Amazon and all that kind of fun stuff. Hey, Sachin, where can we send people? Is there a website you would like to direct people to?
Penguin Random House has a website on the book, and I think there's a dedicated webpage that's coming out. My family office, Achilles, which is just achilleslp.com, that people can just click on the contact button if they have questions or like to continue the conversation. The book is also on Apple. You can get it on the Apple library. There's an audiobook. There's a terrific voice actor, audio actor that they've got to do the audiobook. I think is fantastic, actually. And of course, there's an ebook. Whether you like to read books in physical format or listen to them or look at them on your iPad or Kindle, It's available on all those formats. I hope your audience enjoys the book. I hope we get another chance to connect as well.
I hope I did not surprise you with some questions today. I hope you were ready for who knows what, right? Because I wasn't really sure where I was going to go with you. I like the education you gave me.
I got to be honest. You are asking some sharp questions. They're, I think, the right questions. I think interviews, podcasts, dialogues, discussions, exchanges, we learn a lot when we challenge each other. And that's what I really enjoyed about tonight's conversation. Tonight for me, I guess very early tomorrow for you. Definitely a lot of challenging material. It's okay to disagree. We're not disagreeing on points of values. We are looking at perspectives and trying to get to the right answer. And in a way, that is very much how I think private equity folks do their work. They challenge each other. Some of those investment committee discussions can be a little charged, not in a bad way, but in a way to sort of really try and get to the right answer. I thought it was great. I thought it was really great. I did actually get a brief document from the publicity folks, but I liked very much how you went above and beyond. I thought it was really great. And if it's a topic you'd like to continue at any stage, I'd be absolutely happy and very grateful to come back if you're still covering this space going forward.
Sachin, I appreciate your time tonight. I will keep you posted. And again, thanks a lot. Appreciate it.
Thanks a lot. Thanks for having me. I'm very grateful.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.